for another week of, well, not a week. The stream won't be a week long, but for another week of fun, excitement, macro discovery, deep learning, system dynamics. We're going to cover it all tonight. Excited to be on tonight. We have some fun stuff to show off tonight. Ty, welcome. How you doing, man?
I'm doing good. Doug, how about yourself?
Doing great.
You always ask me how I'm doing. How are you doing, Doug?
I'm doing great. I'm tired, man. We've been working our butts off to show off some of the things we're going to show right now. And this has been a long time in the making. We've definitely shown little demos about this deep learning system dynamic project that we've been working on for a while. Ty, over a year ago, maybe 2 years ago, you had your national model. We've developed that, continue to develop it. And it's really kind of coming out to the culmination that we hoped it would come to. That's what we're going to discuss tonight. And that is what was DeepMMT. We've brought in the best of both worlds with the platform and model that Ty built. We're continuing to develop. We'll come out with new versions. I mean, a lot of this will continue to be cutting edge stuff, and we'll continue to develop as we learn more and build more. But we're essentially showing off tonight DeepMinsky, and that is going to be the final name change for this entire platform project that we have. But DeepMinsky is the final form. It's what we always wanted, and we'll be showing that off tonight. And suffice to say, as you can see from Ty's face, Michael, by the way, thanks for joining. Thanks for saying hi. As you can see from Ty's face, as he said yes. Ty is excited because this really is going to show off a bunch of his life's work. So but beyond the tired, I'm pumped to be showing this off. I guess with no further ado, I'm at least going to get it on screen at this point in time, and then we can start kind of talking things through for what it is that we want to do tonight. Ty, before we get out of the gates here and get going, any other thoughts? Anything going on?
No, this is going on. What's on screen is going on right now in my life. So let's.
Yes. This is this is dominated every waking hour of Ty and I's life for the last about month, but it's in good shape now. So what's on screen is, give me 1 second here. What's on screen is the sandbox version of DeepMinsky, and everyone, if you watch the stream for long enough, you've seen kind of various iterations of this, but this allows us to simulate the entirety of the macroeconomy. What the big jump is, specifically with the sandbox model that's in front of you, is the speed at which it's going to compute is just much faster than anything you've ever seen. So we can try a lot more scenarios out and that sort of thing, and the way it handles shocks to the system and the way that it handles multiple runs or variations of runs is a lot better. And we've added a few other kind of nice features and everything, so it's just gonna be a lot easier to go ahead and simulate and show everything. And specifically what we want to do tonight is assuming you have a pulse and you've been seeing what's going on in the world around you, we had once again a president shock the economy in major ways. And it shocks like what we've seen over the last, I guess since January, that can really throw, any complex system, whether it's just a macroeconomy or whatever complex system you're in that has various feedback loops that create sort of dynamic outcomes. Any system that has shocks, where those shocks are, when those shocks are really determinative of what sort of outcomes you're going to see. And the outcomes, especially in complex systems, where the outcomes aren't going to be just pure linear relationships relative to the input, you need a platform like what's in front of you to really understand the implication of something like what we've seen with the tariff shock. And I think where DeepMinsky is at right now, we can really show off the power of it in terms of what's to come, right? When we built this after the COVID shock, we were able to demonstrate with clarity what would have happened had we had this been built in 2019. But now we can really forecast what is to come based on our assumption of kind of the way this shock has played out. So that is what we are going to do tonight. And I guess with no further ado, we should just go ahead and get going at it. Ty, here's my assumption. Here are my kind of operating assumptions of what's taken place in terms of how we can describe what I'm going to call the tariff shock and what's played out and how we can then implement that. As I see it, what has played out over the last 4 months is we saw the tariffs get announced with the Trump election and the realization that those tariffs were actually going to happen. And when that happened and the realization hit, we saw a massive front running in imports, right? So we saw U.S. domestic companies that need the raw resources import those to build up inventories locally, domestically, and they did that. That had a reverberating effect, and then the tariffs actually hit. And some of the assumptions I'm making when companies did import everything to front-run tariffs is that, one, costs money. Two, it also requires more labor to utilize to fully utilize the warehouse capacity. It also just takes more capital utilization to have in warehouse larger kind of stock of capital goods. And so those are some of the assumptions I'm making. Also that eventually the tariff tax itself would actually hit. Are you good with that kind of baseline assumption and where we're at? Where we're at so far. I think it's probably worth pointing out. Well, you know what? We won't go to this data yet. We can look this up after the fact. But so far, at the very least, that is what the data has immediately shown, right? So, I mean, the data that we do know is we had a shock to the downside in GDP. We had, obviously, imports push higher. We had, more recently, we had employment data come in slightly better than expected. So the employment picture is looking slightly better. And we also saw inflation surprise to the downside, right? So inflation continues to get suppressed. Those are at least the things that we're seeing. Now, when you get into and you run a simulation, a macro simulation, what you need to do, and the way that Ty built this model out, Ty, if you want to explain this a little bit better than I am, go ahead. But this model was built to grow over time. And it is up to you, the person using the model, to understand, okay, where do you want to introduce a shock to the system, or where do you want to introduce some policy change at what point in time? And what we're going to target is particularly a macro environment that's very similar to ourselves. So, Ty, while I get that set up, maybe you can explain that in just a little bit more detail, why that matters.
Yeah. So the model essentially, to sum it up, is a growth cycle model. So it's got business cycles. It's endogenous. The business cycle, contrary to mainstream belief, is not triggered simply by productivity shocks, although that can change the amplitude. The business cycle is a phenomenon. It's a structure of the capitalist system. So it generates its own business cycle. And when you introduce an exogenous shock, so something that's outside of the system, it is what happens is dependent on what point in that cycle you're at. So let's picture like output. It's, in the business cycle, you got a peak and a trough, right? And a shock introduced, let's say, on the climbing part of the business cycle, so before you're in the peak, will have a different effect than, let's say, that shock being introduced on the downside of that peak. And that's a consequence of a nonlinear dynamic system. So one of the main points that eventually we'll start digging into is, one shock to the system is going to behave differently depending on the point of the business cycle we're in. So you can't just say, well, a productivity shock is good or productivity shock is bad. They will elicit different behaviors in the system depending on when those shocks occur.
I like it. So the big takeaway is shocks in their outcomes are system dependent. And if we run them, or system state dependent, if we run them at different system state times, we should expect different results. Not necessarily, but quite likely, because the way complex systems play out. Okay. We can test that out. We can see what the difference would be. I didn't do a practice run of the let's run this on the back end, but whatever. Ty loves doing that stuff live. Not preparing ahead of time. All right. What I want to do is just for kind of example's sake, I want to show that really what we want is we want a couple business cycles to play out in the sense of like what that means for the simulation is that we have now a more mature, more financialized economy. And then we also want to try and catch it as we're close to similar levels in terms of private debt and public debt to GDP, because those are really important in terms of the overall trajectory. And then probably the most important thing is that we catch it and we start the model closest to where we are at in the business cycle. And so I'm going to say relative to this simulation, and again, we have a different version right up here, forecast model that is forecasting the actual future as is throughout time. But this is a simulation and we're just starting this model in 2024. And with that being said, just pretend now that we are at right around early 2029. We're in the early part of the business cycle. Real output is just starting to take off. If you look at things like, again, private debt and public debt, they've been rising now for quite a few years. If you look at, say, the inflation rate around 2029, we're just maybe starting to pick up on the inflation rate. So we're at the general area of where we were at in the current business cycle. Same thing with the employment rate. We've been seeing unemployment push down. We're not quite seeing a tight employment market yet. So
can we change the employment ratio to the employment rate just so we avoid confusion? It's the inverse
on the flip side, then the unemployment rate is right about here then, right? So is it perfectly aligned? No, that's what the forecast model is for. We can show that off in a little while. But for now, we want to play around with the shock in the simulation and find a somewhat similar spot in time to where we are at. So we found that. We're now looking at real output. And now what we need to do is we need to just pull up, because this is going to be important to actually show the firm imports. We want to essentially show this import shock, right? Because our hypothesis is that there was a massive shock to imports because of the tariffs, and there was this front running of the tariffs. And so we can show that. So what we can do is we can add a secondary simulation, and the secondary simulation is what it is that we're going to actually add some jumps to right at the time period that we were talking about. So we're going to add what's called the Heaviside parameter, and we're going to go ahead and the first thing we're going to introduce is the import tax, right? Because we know that we increase taxes on the imports. And like I said, I'm going to put this at 2029 point. I'm going to do 2029.6. And this is going to be I'm going to put it 10% later than we're going to do the other shocks, just to simulate the fact that you don't actually pay the bill and the tax never actually went into effect until a little bit down the line when Trump finally imposed them. So we're going to put a little bit of a delay just to kind of show the realism there. And then we only need to notch this up just a little bit to actually get the import tax higher, because this is an import tax not just on specific countries, but on the entire import bill. So I don't think we need to put that up too much to demonstrate. In fact, we'll run this in a second and we'll put them all together. But I think if I run this, we would actually get a sudden drop in like government spending, which is what we would want. So just a tiny little push higher in the import bill. Then the next parameter on this alternate simulation that we want to run is going to be the capital utilization function. And this is just showing the fact that when the warehouses and the firms that imported all this stuff, they have to now increase the utilization of the capital that they have, the real capital that they have. So we're going to notch this up just ever so slightly, maybe like 21% should be enough to demonstrate that they're putting more capital to use. Go ahead.
So just to be clear, we in the model, capital utilization is endogenous. So
Correct.
The model will predict what capital utilization in aggregate will be for the economy. However, we can shock that function, and that's what we're doing right now. So it's one of the variables in the function that Doug is adjusting right now to make capital utilization use a little steeper. So it's still going to be endogenous, but we're changing the function to simulate an immediate higher capital utilization rate.
Yep. That's a really good point. So one of the things that essentially what Ty is saying is we did actually change the way imports run. Like I can shock how imports run, and it does ever so slightly increase capital utilization. But kind of the macro assumption that we're making, and also just to kind of demonstrate, is that you go in a shock scenario, you have to overcompensate for the normal relationship between the normal endogenous relationship. When a shock happens, it moves things in ways that this thing just we need to overcompensate for that shock. And then two, it'll also just better show the dynamics that are at play. So like I said, we are going to, I need to put this at 2029.5. I think I said 2029.6 up here. Yeah. So we're also going to do the slope now of the import. So this will just increase imports even more, and we will put that to 1, and this will also be 2029.5. So now we have everything we need to show that there is going to be a front running of tariffs. The tariffs are going to hit, and then we can go ahead and simulate this. And what we should see, if we did it right, is we should see a pop in imports right around 2029, mid 2029, and that's exactly what we get. So we're good there. We've induced an import shock, and then the dynamics play out. The secondary dotted line is now the shock line, right? It's the alternate simulation run. However, it didn't stop here, right? Because there is a front running, but these aren't the rates that companies are going to continue to operate forever, right? You front run the tariffs, and now we're already seeing all this roll back, right? So these are all growth rates. So we now need to roll them back and unshock the shock 6 months later. And this is where shocks just become so damaging, because it's not just a one-time resetting of this entire system. You're getting a bullwhip shock twice. You're getting two shocks. You get the I'm actually going to follow through with the tariffs shock, and then it's the actually I'm playing games here, I'm not going to follow through with the tariffs. And so now we need to unravel them and do exactly what we just did. Well, I do that, Ty. If you have anything else to add, absolutely go for it.
And you know what, Doug, I am right into the story you're telling right now. All I can say is what we are doing, Doug and I are doing right now, and just kind of demonstrating with this run, is something economists should have done 60, 70 years ago, right? We are deploying, engineering and physics tools to measure an economy mathematically. And this is outside of the realm of linear regression. And so we're doing nonlinear dynamics, right? So this is like cutting edge stuff that we're showing you right now. And Doug is delivering a masterclass right now on one of the current situations we are experiencing in the U.S. economy.
Thanks for the kind words, Ty.
Somebody's got to pump your tires. I'm going to pump your tires today, Doug.
I appreciate it. All right, so we have now undone all of the shocks, and we're back to the same values as before. So what should happen is we should see the shock higher in imports, then we should see it fall off now about 6 months later in time, and everything reset. And then once we're good, then we know that we propped up. Okay, perfect. We propped up the right simulate, right? We got the simulation in effect to what it was that we would want, based solely on kind of our observational variable, which is we created a firm import shock. Now, here's the $1 million question. What's going to happen from here, right? What other variables can we track? And as we said at the outset, we've already got some of the data to roll in, right? This has been going on for a few months now. So we've got a handful of the data to come in. So let's just do like nominal GDP. And if you recall, the immediate shock to GDP, which is exactly what played out. So you get this repricing of GDP lower, and eventually that will push higher. If we go to, I think it was the unemployment rate, immediately in the immediate aftermath, unemployment just slightly higher. I'm not entirely sure why that was the case, but
so think about this. Because we front run tariffs, we're storing more and more things in warehouses across America that requires slightly more workers. It's exactly what's happening in that dynamic right
No,
away.
so immediately it's a jump slightly higher in unemployment, not the employment rate. Yeah.
Oh yeah. Oh
But
yeah. Yeah.
it only lasted for a very short time, and now you are seeing a beat to the downside, right? So you are seeing expectations of the model say we are actually going to get lower unemployment pushing forward, which we started to see in March, right? So we started to see, and that makes sense to me, right? They hired on people to take care of the warehouses. So that seems to be matching up well enough. And then the other biggie is going to be, I guess we can do this chart and add the inflation rate. And immediately a shock to the downside on the inflation rate, which again, this is exactly the data that we saw play out in the, as it played out in real time. So everything is pretty much tracking with what our model says that it would do, right? And what this gives me confidence, and why we went through at least this first step before we then, ask ourselves, well, what's the next, what comes, is because if we're gonna have confidence in where this model is showing us things are going to play out a year from now, it should at least track out of the gate correctly. And so far, it absolutely does. So what are the next steps from here? Where I want to go back to is not nominal GDP, but really the best measure for this model for overall growth into the future is going to be real output year over year. Are we going to get real growth? And this is going to show, is the business cycle really going to continue to expand, right? And are we going to get the new loans and that sort of thing to continue to prop up growth? As of right now, that's exactly what this thing is saying, is that we are going to continue to get this kind of boom cycle. And what you're seeing is on the amplitude side of things, we are seeing just a shock, right? I mean, we're seeing an increase of the amplitude, and that is consistent with, we don't have to look too far back for shocks very similar to this. This is very, very consistent to the COVID shock in terms of what we've seen, where we are now likely going to get a surprise to the upside in growth where we had the shock never happened. And that's going to take not too long, really, from now. I mean, we're probably a quarter or two away from starting to fully see that in the data. And Ty, cut me off if you need to at any point, but I'll look at the rest of this data. The next thing then is going to be inflation, right? And this is also going to follow with where unemployment is headed, because we are going to get, if this does play out this way, that means more companies are going to be hiring. That's going to put pressure on wages. So there's going to be more inflation pressure. I think this is the big, kind of wild card, almost ironic outcome of this entire thing is I could easily see by the end of this year, and even before Trump came into office, we knew that the end of this year was going to have inflationary pressures to the upside. Well, now even more. There's going to be even more inflationary pressures as we reach what would have been the inevitable end of this business cycle. He's just going to bring that forward and condense all that inflationary pressure into a more pocketed force. And then last but not least, as part of the business cycle continues on, we're going to see the unemployment push lower as the business cycle kind of takes off into the end of the year. So the overall summary that I have is this is going to be very much a replay of the post-COVID period. I mean, the only difference between what's playing out now and post-COVID is we're not getting a massive stimulus to play out yet. We'll see what the Trump budget looks like. But as of right now, what we're seeing play out is very similar to COVID. And the way I'm forecasting this is that if the data continues to come in this way, which it has so far, that we should expect a big surprise by the end of the year. And by surprise, it's not a surprise to us, but relative to kind of where market expectations are, that we're not headed for a recession, we're headed for a boom. We've seen bank credit accelerate way higher, which kind of corresponds to and makes sense in the framework that we have, that there was this big rush to hire and to get import like warehouse builds. And if that's the case, that's new money that's going to drive future profits, that's going to want to encourage future investment. And so I think it's going to encourage this kind of credit boom that we're seeing play out. And that then sows the seeds. Any credit boom sows the seeds for kind of its own demise. And I think that's kind of where we continue to head, is that we should see some surprise relative to the market expectation for growth. by the end of 2025, I think it's also going to be very clear that we might have some inflation issues right around the corner as well, especially as the Fed kind of continues to hold pat on interest rates. So that's how I'm reading this right now, Ty. I don't know if you have any other thoughts in terms of how the simulation looks.
Yeah, so the immediate effect of the simulation, like you said, it's matching everything we're seeing in the the most recent data that we can get. So that's promising. And obviously, as any simulation, if you kind of look further down the line, there's always an air of uncertainty. But the one thing for me, I know like Doug is going to be more on the market end of things and kind of wants to forecast things. But what I see right away is we've introduced instability into the system. That's what Trump's achieved so far in his presidency is instability. I don't know if he's done anything good. It's just now, Doug, can you have you gone down your full chain of causality here? Can we try something else? And
go ahead. Yeah.
Are you going to add some more here, or are you kind of at the end of what you're doing?
Yeah, someone in chat just said, "Can we add the huge spending bill?" And I mean, we could.
Well, let's do it. This is a live stream. We're here to make our viewers happy, and if that's what you want, we're going to give that to you. Doug, can you give that to them?
Yeah. So what I'm going to do is I'm going to lower household income tax by a lot. Okay, we're going to do that. And what that should simulate, we'll do this kind of bit by bit here. And the reason I want to do, because that's what the promise is, that we're going to get tax cuts for the middle class. And we'll do this kind of one bit at a time. And I am just a little curious. One of the things that there's still some bugs that we're working out, and it could be that I'm actually decreasing taxes, not just by 8%, but by 100%. So I'm going to do this incrementally just to make sure that I'm doing this kind of step by step the right way. We'll know if the simulation crashes. Okay, so it did not crash, and I'm instituting it in 2030. So we can take taxes much lower at this point.
What a generous leader you are! You're sure cutting.
God, speaking of uncertainty, I mean, Ty, if there's anything as I have been messing around with this, uncertainty is the worst thing you can put into a complex system that you want to be relatively stable, right? It's just, yeah.
This is why we've got to get this technology in front of actual policymakers so they can tinker with this model before they tinker with people's lives. But we might be a ways off from that, but we'll see.
I'm going to do we have nominal year-over-year output? I don't know if we have nominal output year-over-year. I mean, that might give a slightly faster picture because in real terms, government spending is not going to change a ton immediately, right? I guess we could also add in, we must break things to truly test them. Yeah, that is how we operate in real time. That's completely fine when you're doing it with a simulation tool. But all right, so we decreased. Well, I don't think the plan is to decrease business income tax. I really don't know. But let's just go ahead and do it. We'll go ahead and drop this to just 1. We'll drop this to 5. And here's the current break, if you will, 7.8 to 8% between the two runs at the peak. So not a ton at this point. In terms of the tax policy, I don't really know how this is changing government spending. Truth be told, in terms of the macro outcome, government spending is not like some panacea, right? We track government spending in the sense of what it does to markets, because it is very sensitive to markets are very sensitive to government flows. But in real terms, the outcome is a little bit more muted. In other words, real growth happens because the government spends, but that sets the kind of money floor that the private sector can then leverage up, not that it's the government that's creating the real output. And I think this model does a really good job of recognizing
Yeah,
that
yeah,
exact reality.
yeah. That's a couple order kind of lag in like government spending is beneficial for sure because a portion of that spending, the majority of it becomes firms' profits, and now hopefully it's profits for productive firms. And if that's the case, they're going to invest more, and you're going to see more value created in the economy or more real output. And that creates more jobs. So that's kind of the transmission of government spending, good government spending, not, maybe poor government spending, which obviously the composition of government spending is going to change the degree of the outcome.
I pulled up the our equity market version as well, and in prior versions we were able to show, and I'm wondering if this is just being offset by that the import tax itself kind of did an immediate hit on the equity share, but you are seeing too kind of the now the bubble brewing, if you will, in equity returns that the simulation is showing. So
that might have also been caused by your massive tax break to productive firms that you gave out. I think you dropped it from 5 to 1%. Yes. That's one of the biggest discoveries in the national model for me is if you really wanted to use tax policy as a policy lever, the best lever to pull, but the most dangerous one to pull is how you tax productive firms. Far more impact than any other, whether it's the financial sector, the household sector. It has huge impacts on what happens dynamically.
Bubble from decreased tax breaks. Yes. All right. That's where we're at. It's really what I wanted to cover tonight. Ty, I think maybe one of the things we could do, again, just trying things on the fly here, is
did we like satisfy your need for government spending, or do we got
for now? Yeah, for now. I gotta. I don't want to do this on the stream because it could just take too long. But I don't really know how much I actually shocked government spending there. Right? We would have to.
Can't you just directly increase the spending?
Yeah,
rate?
We could.
We got to satisfy the viewers. See, I'm rooting for you guys. Now, do you want to do household direct spending or spending into the firms?
I mean, household direct spending, well, it would be firm because we're not giving out stimulus. Like in COVID, it was.
Let's give a little tiny bump to firms.
All right. So we've got 30% right now is the growth rate, and we'll go to 35%, and we'll call that 2030 in our model. And then we will add, this probably isn't enough, but what the hell? You know what? Let's shock it really high. And then, damn it. This is glitchy, and I don't like it. There we go. We'll go 39, and then for household, direct household, we'll go to 10. How does that sound?
Wow. Welfare state. Here we come.
I'm seeing a bug in real time, and it has to do with how we're doing that. So let's see if we shock. Oh shit. that is. All right. That was too much of a shock there. Let's lower it just a bit here, and let's do 7. Man, this is really bothersome. I'll just hold it down. No, that'll take forever. Why?
Can you just erase everything?
There you go. All right, slightly more reasonable. Slightly. All right, let's see what this does to inflation. Not all that much, interestingly. We're not.
Well, see, governments, but here's where this is where the libertarians get it wrong. Government spending, like I just explained, turns up in firm profits. Firm profits increase. Yeah, there'll be share buybacks and executives will make more, but they also invest more. And if they invest more into their fixed capital, they're going to actually make more things.
Yes.
And if you make more things, it's pretty hard to be in an inflationary environment because there's more goods matching the increase in dollars. And in some cases, more goods will be created than the actual initial stimulus of dollars.
Which is what just happened when I noticed I didn't have the year right, and I corrected the year, and the gap at the peak of inflation decreased just a little bit. Man, that is kind of a satisfying reality. The government can print its way out of inflation. With that being said, we've added that. I think what's worth doing now is just trying this out live, where we move everything to the backside of the cycle. So real output year over year. Let's move everything to 30. We'll go 2030.7. We're just going to move everything to 2030.
You're just going to move every shock up to the backside of the business cycle, correct?
Correct.
Okay. Yeah, this is going to be interesting.
And yeah. See how this ends up playing out.
Oh, and Michael, yeah, we'll be doing Steve and Friends in the future. I've just been super busy with this stuff. But it will be coming back in some shape or form. I just don't know how.
Hey, Ty, in our Discord server, can you add that I need to add a button that can actually copy the secondary simulation to the primary simulation? That would be really nice. Remind me to do that, because it would be really cool to copy over right now.
Yeah. A secondary button.
So right now I can copy everything that's in the primary, so in the red, down to the secondary. But it would be really cool if you like the secondary run that you just built to actually now make that the primary.
Oh, okay.
Yeah, you don't have to write it down, but if remember that, because that would be really cool. It'd be really cool, because what I really want to do is, we'll have to like see it jump in real time. All right, so we're going to do real output. We'll stay on real output, and I'll just take a screenshot, and I'll pull this up in a second for comparison's sake. I'll keep this to the side. I don't know, what should we stay on? I'm just going to stay on inflation, because I think it's so much more fun to watch. But we're going to now implement all these shocks on the backside of the business cycle, and we're going to see what plays out here. Absolutely nothing. which is what is fascinating about this is we got a completely different outcome because we implemented it in a completely different system state, right? And it's the muted response here is the fun response. Look at that. This is so wild. This absolutely tickles me pink, Ty.
So the lesson here in dynamic complex systems and chaotic systems is when you implement your policy matters just as much as what the policy is, right? Because your policy, you can define it and have it structured well, but it's temporally dependent on its what results it's going to produce. Right. So that's another thing that's not in economics, right? Where we look at statics essentially, and sometimes we'll group them together and look at what's called comparative statics, but that's not continuous time modeling, right? And so this is a key insight that, hopefully the whole field and finance will learn. Going into the future, that policy changes are time dependent on producing good results. Like in this case, whatever Trump wants to achieve, he may have been able to achieve them and still had a stable, like we're in a stable pattern. There's very little change there that's real output. That's stable. The system is still stable, and maybe he achieves some goals if we looked at some other policies. But it just goes to show that implementing a policy at one point in time is going to be different than implementing it at another point in time.
That was fun, man. That was one of the cooler one of the cooler live things that we've tested out that turned out to really prove our point, is that if we are right in our initial estimation of where we were at in the business cycle, and that's why we went over all the data ahead of time to say, like, this is what our expectation is of the immediate outcome. So far, it's playing out very similar to what the simulation would have, which makes me think, yeah, we actually did hit this shock during the uptick of the business cycle. And if we were sitting here in, say, 2022 and this all took place as opposed to 2025, you're going to get a completely different outcome. And I mean, and that's also too, when I look at the landscape of like the big macro names that are making calls right now, so many of them are so bearish, right? And it makes sense if all of their algorithms just happen to catch the data in terms of like kind of the sort of regression type analysis, econometric analysis that they've done historically. If that data correlates and this sort of stuff happens during downturns, and they're seeing, okay, well, the outcome is going to be disinflationary, degrowth sort of stuff. Yeah, that makes complete sense because they're using an econometric static sort of, like you were saying, static sort of analysis, when system dynamics gives us the ability to do true dynamic complex system forecasting. And yeah, I'm pumped. I think we're right, Ty. I think it's going to be an inflationary mess in the not too distant future. And I'll tell you what, the one thing that's saving the day right now is oil. I mean, the fact that oil has not skyrocketed is really, really helping out. And if oil ends up flying higher, we're going to be in for a rough time, man. But all right, that's our call. Inflation higher, growth higher, surprise, business cycle pop. The big question too is how long does this pop land or last? Do we have 2 years of a business cycle pop? Do we have a year of a business cycle pop? Do we have 6 months of a business cycle pop? That'll be something that we'll have to see as the data rolls in, what this thing is looking at like. But I still am very much on the. I think DeepMinsky is right, and that we're going to see this thing take off in the short term. I am now looking at chat, so if anything is rolled in that I haven't responded to, I'm going to bring my attention to it again. But that's kind of what I am expecting.
Do you want to give a very small preview of the forecast model, or no?
I can maybe let me actually show off. So the forecast model there's some bugs that are happening with it, but we can certainly demonstrate the reality in the dev model right now. And the reality is that we're going to end up with two things. We're going to end up with the sandbox and the forecast. And the forecast is actually pulling in, and you can see what it says it right up here what it's doing. It's actually pulling in all the Z1 data in real time and putting that into the model itself. Right now, it's not perfectly calibrated. It's called the dev model for a reason. The parameters are far more sensitive. Everything you can see over here in the initial conditions are far more sensitive, and we're getting that all set. Hopefully sometime next week, maybe the week after, it's ready to show in real time. My point is, this is not the actual dynamic that's going to play out. What I want to show is we're actually pulling right from the Fred Z1 tables all the non-financial business gross value added transactions. We're showing off the average wage level, and we're grabbing this data directly from Fred, inputting it into the model, applying all of the theory and dynamics that you see in the sandbox model. This is really where the DeepMinsky, this is where the deep and DeepMinsky is going to come in. We're going to start to add in that deep learning, machine learning layer to better understand the relationship between these variables, since we're pulling the historic data, and get an even more accurate forecast. And so that's what this model is. I could show the forecast model. It's just not going to make. It's not going to make much sense, but part of the forecast model, when it gets done, is it's also going to show the strategic implications of that for for where we're at from a like positioning portfolio standpoint, right? Like what is the implication of the fact that we're probably heading into inflation? What is the implication of kind of a growth boom? Where do you want to be invested in, given where these variables are headed? So that is what is on the docket. I don't know, Ty, if you wanted to add any other part of this.
No, we'll add more once we get a
Okay.
little more Cal. We can also, I think do the really what the best thing about this whole site is the landing page.
I'll pull that up in a second. One thing too, I guess, that I can show real quick, and what's really nice about specifically the, what we really are calling the DeepMinsky forecast model is you can reset it to say 2010, and it'll repull the data from 2010, and you can notice that the actual gross value added is only at about 9.5 trillion as opposed to the whatever 19 trillion that it was at. So it's pulling in the data, and you can see this relative to the year. So it's very easy to not only just kind of back test. The problem with back testing with dynamic systems and everything we're doing is it's not just pure econometrics, right? You actually have to reproduce all of the measurements in real time. But if you wanted to play, well, what would have happened had XYZ policy went into action? I mean, this is absolutely the way to do it. So you can really theory craft what would have happened had certain policies played out or not. Ty, did I cut you off on what you were saying there, or were you jumping on to another point?
No, I was just talking about the landing page.
Okay.
But
that's right, the landing page. Landing page. Let me show just a couple other features that I'm super excited about, and I think will offer users just the ability to explore whatever theory they want. One thing we're going to add in that I've built out, it just needs to be added. Next time we show this off, we'll absolutely do it. Is we do have a large language model that can read not only obviously all the theory that we're going to give it in the model itself, but it can tie that back to the data itself. And we've built some and have some machine learning algorithms ready to learn. Like if you ever built in Vensim, and then that's the big one, right? The most powerful system dynamic tool.
Stella and Vensim, yeah.
Yeah. If you've built in those, that they have built into them various tests like sensitivity analysis and that sort of thing. And so we're building that sort of functionality into this, not necessarily for us to do that with the model, but for the large language model to understand, okay, here are the variables that are most important to the outcomes that we're seeing right now. So when you talk to the chatbot, that is not just going to be like a chatbot. It's going to have information for you to dig into. The other thing you can do is you can add, and this is kind of an important piece to all this, but if you add, Ty, what were the three? Firm equity, firm assets.
The three equities for the productive firm.
Yeah.
So firm, so financial equity, real equity.
That's what it was. That's what it was.
Share equity.
Firm. Was it assets equity?
Well, that's a weird variable. Those are the three on screen. Oh, you've got nominal inventory.
Yeah, I'm changing them. I'm forgetting what the names were.
Oh, okay. So firm financial equity, firm nominal, firm capital. What variables are you looking for?
The three that we decided.
Okay, so financial equity, real equity, and share equity.
Yeah. All right. So what's really cool is like what I'm building up here is essentially the valuation of the firm sector, right? So the valuation of all the companies in this model. And this is one of those things where one question people have had. So I'm essentially putting what is the price of the entire private sector, right? Like that's really what I want. I want to create what is the valuation price of the firm sector as a whole. And we didn't have that specifically built out, and it's not even something, we'd have to hard code it in. So we can create a formula and just add those three together, right? So now we're actually building the total valuation of the private sector. The next thing we can do is we can do firm profits, and we can add that in as well, show what the profits are and show the valuation. And now what we can do is we can edit this formula and say, okay, I want to do price to earnings and get that. And here's what's awesome is there's been a question as to why has the PE ratio, the CAPE ratio, risen so much over time, especially over the last 20, 30 years. Why are we seeing this massive outperformance relative to the historical norm, right? And I can, let me pop open another tab real quick and pull that up and show you that the reality of the Shiller PE ratio pushing higher over time. And the big question is, why have we now spent so much time in rare air in the PE ratio since the 1980s? Why has this played out? And, a lot of hypothesis and whatnot, but without us, and it was kind of proof that we certainly did not do this, looking to do this exact, outcome. This came endogenously from the model that it kind of, ad hoc type Shiller PE ratio is showing exactly what we've seen play out, these cycles of this thing continuing to push higher and higher and higher over time. And what I am excited to explore is why the hell is this happening? And we can certainly start to hypothesize, public debt rises over time, private debt rises over time. Can we change public debt to not rise, but just private debt to rise? Do we still get it? But the hope with the AI model is it can give us some good hypothesis too, because it's going to have the context of the entire model and the ability to kind of test various sensitivities with the model to hopefully come up with some sort of reasoning. So I think this is what's awesome about what we've built and about what we can do is there are things that we're thinking of that we're discovering that we certainly never set out to have the model look like this, but yet here it is, seeing this increasing PE ratio over time, just kind of proof positive that we've dialed this model in with stellar accuracy to see these realities play out. Any thoughts, Ty, beyond a pat on the back to getting it right?
we could. Yeah, there's actually, I have some ideas about this, but I think we'll save it for next week. But this specific chart, because it's live, and if we add things, yeah.
Come on, Ty. What do you want me to try? I'm a little curious.
Let's just try to add a bank equity into the A plus B plus C equation. Okay. So add it to the equity. So I think it's called bank equity. Yeah. And then add that. Oh, it's even crazier.
That's wild. Okay. That's wild.
I expected. Okay. So this is the great, I'm going to tell everybody. In system dynamic, the study of system dynamics, it's used across all different fields. Okay. We're kind of novel in using in economics, but there's a concept called your mental model and your math model. And so my mental model in the moment was like, okay, well, Doug, we can just add the bank equity and it'll probably flatten out your PE ratio and I'll make you look bad on air. And that was my mental model. And Doug was like, come on, throw it out. And so we did. And it has the complete opposite effect of my mental model. And it's a big thing in system dynamics is we have these like ingrained ideas in our brain and it's hard to beat them out. We have these pathways we form, our logic forms, and it starts breaking down when you add one more variable into it and one more variable. Your belief will stick with it, but the reality is when you actually model it, you get an emergent behavior that you did not expect in the model. That's cool.
Oh, I added this parameter to the wrong. I needed to do a secondary simulation. Okay, what I did is I changed government spending to 20% from the beginning of the run. So actually, let me set this here. Let me go to, actually, I can just do it right from the start. Yeah. We're going to go down. I don't have to deal with the heaviside functions. We'll go to 20%. Household spending. Well, let's do these one variable at a time. What the hell? So I'm doing this right from the start of the model just to see what this thing looks like over time. Maybe I'm wondering why that's not actually applying, because it did earlier. Okay. Well, maybe that's I'm going to take a screenshot of that to remind myself, chat, that is apparently a fix that needs to happen. So I will add these now as a heaviside function. But what I did, Ty, is I put government spending at 20. Yeah, I'm not sure why that's not showing the alternative.
Well, it wouldn't show does it show the alternative if you don't run it in a heaviside function?
Yeah, it should. Yeah. I'm wondering, you know what it is? You know what I bet it is? I bet that's exactly what it is.
It's the equation.
It's the equation that is doing it. Yeah. So I wonder if okay. Now if I redo this equation, I bet it will apply it. Okay. That's an interesting bug. Chat, thanks for sitting through that. A plus B plus C plus E divided by D. No. Okay. So we know what the problem is that it's the equation that is causing the issue. But what we absolutely can do, and I can remove the secondary simulation, reset defaults, set it to the default run, and I will just now diminish this to like about 20%. And notice how we went from what we'll call it on average 19.5 to 21.5 over time. Now, if we run the simulation, we start at, we'll call it 19.5 at the same spot, but we never grow when we turn government spending down. So my initial assumption is government spending is probably pushing PE ratios higher, and that is maybe an explanation. And we really did see in the 1980s and the financialization at that time frame, government spending really start to take off, especially as a percent of GDP. It makes me wonder too, as I'm just talking out loud then, how easy would it be? I guess credit growth is a function of it's not something that's exogenous, right? Like we'd have to
so there's multiple it's got to do with profits for firms, the interest rates for households. So it's
there'd be a lot
to kind of calibrate
to do this live. Yeah,
that depends what are you trying to achieve. Maybe we can do it live.
What I was thinking is, you know, part of the reason why the PE ratios are so historically high, maybe not might not only just be because of government spending being so high relative to GDP, but also the financialization as well, right? Private debt just pushing higher over time. And if there was a way to cap or curtail private debt growth, I
think if you could cap it, right? Because ultimately it's a function of profits going down when there's less government spending. And then if any of that lack of government spending is compensated by private debt creation, that becomes a cost to the firms if they're taking out more loans. So that reinforces the cycle and profits go down even more. So it'd be a multi-dimensional issue, but credit debt would be a factor in it.
Okay, well, we discovered one thing tonight. That is that without a doubt, part of the explanation is we've seen a massive acceleration in terms of, and I think I'm right in that let me pull that up. I want to pull up in public federal debt as a percent of GDP. Yeah. Yeah. So I don't know what this looks like historically. I mean, I think in the 1950s it went through the roof because of following World War II, or I should say in the 30s and 40s. But I think we're at historically high levels of public debt to GDP now. So maybe, just maybe, had we not gone through the inflationary age in the 60s and 70s, or the stagflationary age in the 60s and 70s, we could have had the PE ratio continue on the trend that it was at. I mean, if anything, if I were to do a very long moving average through this chart, I think what I'm seeing is exactly what government spending was, right? Obviously, the Great Depression happened, and that was when government spending was really at its lowest, causing the Great Depression. Then you had the huge post-war boom, followed by the stagflation of the 70s, and then the massive ramp up. All we're seeing here on this chart is that push starting from the 1980s. Gross federal debt held by the public. Do any of these go back?
That one right there. Second one.
Yeah, okay. That's exactly what it was. Okay. So we had a huge post-war boom followed by, or I guess war boom, followed by a consistent fall into 1980, and then it's been 1980 upwards. So, okay. I mean, that's one very reasonable explanation as to why that reality has been the case. So, Ty, hopefully we've set the stage, and next week, when we show off even more where we're at, there will be an appetite to see it.
I think we should do the landing page. I know it means more,
yes,
probably to me than anybody else on the planet.
No, I spent an inordinate amount of time. I have to log out, otherwise you won't be able to see it. But there it is. Let me actually refresh this bad boy so everyone can see it in real time.
Okay. Are you going to explain what's going on here?
Yeah. So for those of you who are in the know when it comes to system dynamics, the classic equation is the Lorenz equation. If you've ever heard of the butterfly effect, it is what you're seeing right now. This is the butterfly effect. And what it's demonstrating is that even small changes in initial conditions mean two objects that are started on the exact same trajectory, but just slightly different in their initial conditions, they will track immediately following each other. Those initial conditions will set them off in different directions. And Ty, you can explain that a little bit better than I can. But as Ty jumps in and does a better job of explaining chaos, the cool part, this is a real simulation running. This is not a animation that I just recorded. We can sit here for the rest of the night, and I would love to do it, and it's never going to repeat the exact same pattern. It is a real simulation in three-dimensional space, so it is picking two spots. Technically, I guess, in theory, the same spots could be chosen again, but they won't, anytime soon. And so every simulation run is going to look just a little bit different, and it felt like I wanted to do this because the project we put together deserved this sort of attention. And so if when you guys go to the site and you watch the animation, you'll know this is a real simulation running.
Yeah, that is really cool. Like, that is not just a GIF in the background or a video. That is a simulation run, and so Doug has set it up to have a random number generator that's kept within a parameter, so we keep the shape of the butterfly. And so it's starting with 3 new sets of initial conditions on each time it generates, and that is the crux of people like Steve Keen, myself, and many others. Really just a handful that have tried to push system dynamics and complex systems into economics, is that your initial conditions are highly sensitive. So if you're wrong there, whatever you're forecasting, it's gibberish, right? And it can have a massive effect And it also kind of ties into where we were showing how if you implement a policy in one system state, it has a set of effects, but if you introduce it in another system state, it's a different dynamic, right? So it kind of ties into that. There's actually, and I have this, Doug, I'll send it to you. It might not make sense for this because this is such a classic shape in chaotic systems.
Yeah,
It's called the finance attractor, and it's a chaotic system too. 3 ordinary differential equations with 3 parameters, and it makes a little shape too. And it was named the finance attractor. I can't remember the 2 guys. They were into finance, and they kind of made this chaotic system. And it was pretty cool. I modeled it.
Okay.
Yeah. You should see a picture of it. Yeah. It almost looks like the finance. There it is, right there. The finance attractor or whatever they call it. And so it kind of looks like a butterfly. Not as dramatic as the Lorenz equation. And there's the blue ones right there. The light blue up left-hand corner. Yeah. That's a different one. That's a 4-dimensional one. Anyways, these are chaotic systems, right? So they're deterministic. And if you plot these, and they're plotted on the X and Y axis with time, but if you just plot them on a graph, one of the variables, and plot it through time, it looks chaotic. Like it looks like instead of aperiodic cycles, instead of aperiodic, which is normal, they're non-periodic, and so they look like they're random and chaotic, like it's a random number generated. But the cool thing about complex chaotic systems is they're deterministic. They start from a certain set of initial conditions, and that sort of stuff goes back to like the way we interpret our universe. There's an argument: is everything deterministic in our universe? Did we start out with a certain set of initial conditions and they evolved over time? And you can't solve these systems analytically. You can estimate them numerically, but you can't solve them, right? So it starts boggling the mind, right? Or are we like, is the universe truly random? Like when we go down to the quantum level, we're not sure yet, right? Exactly if that's truly random, how one piece of a particle can be in 2 separate places at one time. Like that's cutting edge physics stuff. But one thing we have learned, like the movement of planets and stuff, they're all set by a certain set of initial conditions and they look chaotic over time, but they're not. They're part of a system of endogenous behavior, and you can estimate them over time. And I kind of went off on a math.
It was fun. Rant. It was fun, man. We needed that to finish off this stream. All right. Can you comment on thoughts for the next 6 to 18 months? Yeah. I mean, really, I trust the simulation here. And I think over the next 6 to 18 months, it's going to play out something similar to that. I mean, we'll see. We'll see where we go from there. But that is, thought I'd show you. It's a new pattern. I mean, pretty much everything I said tonight is what I do generally expect to play out. So, all right, stream. Tonight was fun. If you're watching this after the fact, let me know some, put in the comment or something like that, some things you want me to run or want us to prepare for next week. But we'll have some fun stuff to show off then. As well, does the sim take into account money destruction via tax and tariff? Yeah, absolutely. It has. It's fully stock flow consistent. It's fully going to capture the money dynamics that you all have come to know and love from an MMT post Keynesian perspective. So when taxes come in, it's not being destroyed, but it's heading back into the essentially what the Treasury general account would be.
What we don't have in the graphical interface yet, and hopefully we will in the future. Yes. We have so many other things that take to higher priority, or a set of tables, like accounting tables, whether they're godly tables or T charts that would actually show those accounting dynamics, money creation and destruction, taxation at all different levels. So reserve accounting, bank credit accounting, international transactions. Like maybe I'm sure one day in the future we'll have those tables so you can visualize that too. So yeah.
Yep. But it's all those dynamics are in there. I mean, every dynamic that we've put in is obviously as close to true to life as we possibly can, and that's why, with regards to the forecast model, which is using empirical data, we have to pull in exact values and calibrate relative to those exact values, because that's exactly what we want to do. We want to track the entirety of the Z1 financial statements for the U.S. Quarter to quarter and forecast off those, which will be so much fun. I'm trying to gather some notes for the white paper and stuff, and it's like people forecast GDP by like regression and stuff like that, and it's hard to express how crazy it is what we're doing. We're forecasting GDP by forecasting every variable that goes into GDP, not by regression, but by underlying theory, right? So, we obviously have work cut out for ourselves, that sort of thing, but it is so much fun to see this stuff all come together. And it's not just a GDP forecast. We are forecasting every single stock and flow through time of the entire macroeconomy that gets reported, and then from that deriving the outcome. So, yeah, as you can tell, we're super excited. All right, that is the demonstration we have for tonight. Everyone, thanks for jumping on, and I think I've got nothing else, Ty. So if you're set, we'll call it a stream. So until next time, everyone, good trading, and we'll see you then. Have a good night.